Hi everyone, Marcus Brussee here. I'm a commercial lender at Mercantile Bank, and we are here to talk about the 5 C's of credit. Appreciate everybody tuning in. The 5 C's, so as you can see laid out right here, foundational concept. Every commercial banker learns of these 5 C's of credit early in their career. It seems pretty basic, or likely seems pretty basic for you, but very important. It can be used throughout this project for you, but also throughout your career and really throughout the financial world. For example, on the personal side, if you go buy a house or a car, you would certainly be subject to these. We're going to focus here on the business side of things and looking at a business loan, and that's certainly something that every bank really focuses on as they're underwriting that risk. So the 5 C's are really 5 pillars to understand risk and determine the credit worthiness of any potential borrower. So something that's used widely throughout the banking industry, and wanted to dive in for you. So some banks do weigh them differently and factor them in, each of the 5 differently throughout their process, but at the end of the day most are at least taking into account each and every one of them towards a whole. So the 5 C's are character, capacity, capital, conditions, and collateral. And there's going to be a few additional videos that dive into a couple of these topics a little bit further, but wanted to give you kind of an overview of the 5 C's here. So the first being character. This is often viewed, in my opinion, the most important of these. I think about it as a willingness to repay the loan. So some folks might have $1 million and be very able and able to pay, but unwilling to pay the bank back given their circumstance for whatever reason. And that's obviously not a great situation. So you want to have a willing borrower that's willing to pay back the loan. A few characteristics that go into this that you can think about as you're assessing this character is their experience, both on the individual side and on the business side, what they've done in the past that would lead to success here. Their education, are they prepared for what they're doing on a day-to-day basis? Also their community involvement. It's great to see somebody that's active in the community. All of those are pretty subjective measures. It can be hard to validate, and at the end of the day they're not 100% accurate too. It might not lead to the right decision, but it's something that should be factored in along the way to help when you're looking at the loan. A little less subjective along the character side is credit score. It obviously provides a pattern of behavior, specifically with loans in the past and how you repaid those and the circumstances around that. So that's something that's kind of within character that's of use for the banks as we're looking at loans as well. At the end of the day, character really comes down to the responsibility of the lender, the relationship manager. They have the day-to-day relationship with the customer and are best able to assess that risk when they're looking at a loan. If you're in a meeting and something just feels off or feels a little slimy after you leave the meeting, maybe it's something that you just don't pursue any further, or at least dig into a little more. And that's a little bit of the game of it and understanding who you're working with and what that looks like. So, from my opinion, character is the most important and non-negotiable of these, and it is definitely a need to have. The next up is capacity. So character is the willingness to pay. Capacity, or sometimes called cash flow, a lot of times in the business that's what people refer to it as, is the ability to pay. Can the business literally support the payments of the loan as it repays it? Also very important, there's a specific video coming that you can watch with a little bit more detail and walk through a specific example here. But combined with character, that willingness to pay, the ability to pay provides a really strong combination. Those two together will just themselves give you a pretty good relationship with that borrower and a good chance of success for that loan. Next up is capital. So with capital, I kind of think of it as skin in the game, quote unquote, or the strength of the company's balance sheet. A lot of metrics that can go into determining how strong a company's balance sheet is. And there's also a video coming on analyzing financial statements that will help with that. But can look into a few metrics such as debt to worth or current ratio, or just the pure cash or equity that's on the balance sheet from a capital perspective as we're looking at a loan. At the end of the day, it boils down to either on a project-specific basis, the initial equity that the business is putting down for the purchase, or the profits that are retained in the business. And both of those items really just provide that extra buffer or cushion or margin, whatever you want to call it, to kind of get through a bad time if they do come up. It provides just that little additional security that you might need to weather the storm if the business is experiencing a short-term blip. For example, if you have a couple clients, maybe 2 or 3 clients that make up 90% of your revenues as a business, and you lose one of them, they just call up one day and say, we're pulling our business and taking it to our competitor across the street. That's something that's a little bit outside your control. You can fight for it, but if you have that balance sheet, you'll be much better positioned to withstand that and able to repay the loan until you're able to get back to a position that you're able to pay the loan from a cash flow perspective. So that's why we look at capital from that perspective, and having that strong fortress balance sheet is really important to get through those times. And also just having the skin in the game, like I talked about, kind of cash down, just keeps the owner of the business motivated to help you get through that time that might be a little more stressful on the business, rather than just kind of throwing you the keys and saying good luck. So those are the situations around capital. Next up, in terms of the 5 C's, is conditions. Conditions really talks to external factors that are a little bit outside the control of the company. Think about industry trends, whatever's going on in that industry at the time, maybe the state of the economy or macroeconomics as a whole, something, maybe a recession is going on or a long-term growth period. We want to understand what that looks like. There might be specific regulations within that business or industry that we want to make sure we're assessing that risk around it, or even political change that might affect the business in some form or fashion. These obviously all play a factor in the level of risk for a particular loan that you're looking at, and need your consideration on upfront. Other conditions that might be a little bit more controllable from the business perspective, that management can at least help navigate through, might be the relationships with the clients or suppliers. I mean, if you have strong client relationships, it can help you really get through any issues that you may have from a day-to-day basis with your clients. Same thing with the suppliers. If there's pricing issues or anything like that, if you have a strong relationship, management can help navigate that and get you through those conditions there. Others might be material pricing increases if you're in an inflationary environment, or availability of labor, all of those things, including your competition, the competitive landscape. If your competitors are doing something that's unique or that will impact your business, I would consider that a condition that we want to know about and understand as we're analyzing a potential loan. Again, hopefully those things are more controllable, but some of these factors are certainly external to the business and not much you can control. We just want to at least understand it as you're entering a transaction. All of these tend to be pretty specific to each borrower and transaction, but they can have a pretty big impact overall. And then last of all is collateral. Collateral being the 5th C here. This is basically the asset that secures the loan. That could be accounts receivable, inventory, maybe your car, equipment, real estate, all sorts of different loans that it can apply to, and all sorts of different collateral that can apply to a loan. There's also a video forthcoming on this specific topic to get a little bit more in depth on what that looks like. It's really a backup source for repayment amongst these 5 C's. It's kind of the last resort would be to liquidate the collateral to repay the loan. Honestly, it's the last thing that a bank wants to do. It costs or can be expensive and take a lot of time. And so we'd much rather have the ability or willingness to pay without needing to liquidate the collateral. But regardless of that, we still need to understand it up front to properly assess the risk of the loan. So in conclusion, I think each of the 5 C's in their own right have value. And like I said, many banks look at them from a different perspective and maybe weigh character or capacity way above the others, or some might look at conditions or capital above the others as well. But they have the most impact when you look at them on the whole. So if you're analyzing each and every one of these for your transactions is when you'll have the best assessment of risk. So character being the willingness to pay, again, capacity being the ability to pay. And with just those two, you have a really strong combination. And probably a pretty good customer, but it's important to look at the others as well. Capital being a strong balance sheet to withstand any issues, conditions. Again, external factors, you want to have a management team that can help get you through any bad times. And then, like I said, last case or last resort would be to liquidate that collateral in order to get repayment on the loan. So again, the 5 C's here, a foundational concept that all banks use, and very helpful in this project, but through your career as well. And there'll be a few additional videos forthcoming here to get in depth on a couple of these topics. So that's all I have for now. I appreciate you tuning in. Thank you.